Hi there again. This is Roger Otten, your course coordinator. Um, in this short video, I would like to take a little bit of time to reflect on the things that we did in week 3 of the course. Just to remind you again, this was the upside down triangle or pyramid that I tend to use rather often throughout this course because it does give you a bit of an overview, the overarching idea of the course, which is that week by week, we walk through the investment process for an institutional investor. And typically, as I mentioned before, the institutional investor goes through several steps. Key in all of these steps is that first you need to figure out what's my investment objective. What's my objective for the long run, which in this case we could call a liability. So it could be for an insurance company, you have to pay out a life insurance policy at some point, or for a pension fund that you need to pay pensions at some point in the future. So your liability, that's your future payment that you are currently saving for. To be able to meet that future payment, you need to have return. And return you get by investing in assets. So the first step is always determine your objective and then find assets which allow you to create a return to meet this liability, this objective in the future. This is ALM management. After you've done that, you step over to strategic asset allocation. And actually, that's what we did this week. When we looked at the article by Campbell and Visera, we looked at how the liabilities and my future goal, my objective, how does that influence the way we invest? So strategic asset allocation is all about where to put the money. Then later on Wednesday, when we talked about the article by French, we looked at whether tactical asset allocation, which means trying to beat the average, and selecting a manager, where we looked at active and passive managers, whether that is wise or not. So in week 3, we actually go down this triangle and we go from ALM to SAA, TAA, and to manager selection. This again, to help you to connect the dots and to see where we are in the course. So what we did this week? You read the article by Campbell and Visera. And yes, I guess you realize this is a tough article. This was Journal of Finance, 2 top authors. But at the same time, I already warned you in the syllabus, you don't have to understand all the formulas, all the nitty-gritty, all the footnotes. I'm much more interested for you in the implications. And the implications are vast. So what we learned from this article is that the liabilities do influence the way we invest. Because in the end, we found out via Campbell and Visera that risk return is not constant over time. It varies actually. And to make it more tangible, what we saw is that equities in the short run are very risky. They can go up and down quite a bit, high standard deviation. But as soon when you lengthen the horizon, the risk of equity goes down. And why is this happening? This is because of time diversification. So the longer the horizon you have, the more time you have to wait and invest, the lower the risk of equities become. And this was an important insight from this article. So from Campbell and Visera, we take that the asset mix that we choose is influenced by the time horizon we have until we have to reach our objective. And again, in our situation where we look at a pension fund as an example, I took this graph from the opening lecture, which shows you the liability profile of a random pension plan. So on the horizontal axis, you see years going forward, and then you see how many millions the pension fund has to pay out in a certain year. And then you see that, for instance, around 25 years from now, you see that the bulk of the pensions has to be paid out. So what we then say, this pension fund has an horizon, or also called the duration, of around 25 years. If you would now translate that to into an asset mix, you could say, because this pension fund has a rather long time horizon, it can bear the risk of equities in the short run. Because it can wait until actually the risk diversifies away, becomes smaller, and then reap the, let's say, the benefits of investing in equities. If you would have an investor which has a much shorter horizon, for instance, less than 5 years, that investor would probably not invest in equities at all. Why? Because this investor has less of an horizon going forward and therefore cannot bear the short-term high volatility of equities. So this is an example of how the structure of the liabilities going forward into the future, how the horizon influences the asset mix. And that's the major insight of the article by Campbell and Visera. Then we went on in week 4. Sorry, it says week 4, but of course this is still week 3. Sorry, guys. What I meant to say, this was of course the Wednesday of week 3 when we talked about the article by French. And this is one step down in the triangle again, where we move from strategic asset allocation, we move into tactical asset allocation, which means deviating from your long-term goal and trying to find a manager. In the article by French, and hopefully you also had some nice discussions on that in your tutorial group, they laid out the costs of investing. And more explicitly, they talked about active versus passive management. Where active management means you're trying to beat the market by constructing a portfolio that deviates from the market, passive management is the easy way out. You just copy the benchmark. And the most common way or instrument to do that is to buy an ETF, an exchange traded fund. Do you need a lot of knowledge for that? No, you just need a computer. You need to know what's in the index, you copy it, and there you go. So fees are extremely low because you don't need a PhD in finance actually to run a passive fund. On the other hand, the active fund employs lots of people who are, trained to be an investor, and by doing that, try to beat the average investor. If you now look at the market around you, you will find that the majority of the investment market is still active. That might come as a surprise to you because, of course, in previous finance courses, if you read all the theory, you would have read that actually finance theory would tell you that markets are efficient and it's impossible to beat the market, let's say, year by year. So theory would tell you that the majority of the market would be passive. In reality, actually, we see that the majority is active. Now, why is that? I think a couple of reasons. One of them is probably because of the fact that most investors, and I think it's mainly this holds for retail investors, so not the institutionals, are overconfident. Because yes, theory says, on average you cannot beat the market, but guys, let's be honest, who wants to be average? So typically investors would say, I'm not average, I'm smarter than the others. However, if of course the majority thinks that one is more smart than the average, this is something we call overconfidence, and that we see a lot. In addition to that, of course, we also have the other side of this equation. So the retail investors would be the buyers, but of course we have sellers of funds. And if you look at their marketing power, of course, it's obvious that if you are an intermediary or you are an asset manager, you'd rather sell active funds, right? And why is that? Because on active funds, you earn a much higher fee. So if you're sitting, let's say, in a fund supermarket and you have a shelf behind you, you either have active or passive funds, of course you would push the active funds. Why? Because you earn higher fees on that. And it seems that indeed most retail investors are sensitive to that. So driven by overconfidence and marketing by sellers of the funds, they would go for the active ones. If we now look at our institutional investors, which is of course the aim of this course, you'll see that actually institutional investors are less prone to overconfidence and this marketing power. What they're doing at the moment, and that's something I think it's important for you to realize, is they're moving away from this majority being active. And what they're moving to is something we call core satellite. Now, what is core satellite? Yeah, I put in a small graph in the bottom left. It means that they partition the market actually in two buckets. And for that, they use a criterion on, can I actually beat the market? So do I have sufficient information to beat the average investor? If I have sufficient information, indeed, I would go active. And that's what we call in this core satellite, we call the satellites. So satellites like private equity, private real estate, hedge funds, you could also add infrastructure here. These are markets where institutional investors think they can still beat the market by having superior information. And to a large extent that would make sense, because in the private market you can actually find information which you don't have to share with others. While if you would be in a listed market, like for instance US large cap stocks or international large cap stocks, these are listed companies and there's a lot of research on that. So it's probably unlikely that you as the only investor have found this information and actually then can profit from that. So core satellite means you deviate the market in two buckets. In the bucket where you think you can beat the market, you go active. And in the bucket where you think you cannot beat the market because it's too efficient, you go passive. So that would in the end lead to a passive core of investments that you think in markets that are efficient, and around that you have active satellites. Now, why is this so important? First of all, this is a trend among institutional investors. And one of the reasons they do that is to lower fees. And that's something I put down in the bottom right graph, which is just for illustration. But fees are very important in the long run. So French talked a lot about average fees, but also to put this in perspective. So an institutional investor invests for the long haul. So we're talking 30, 40, 50 years out. And maybe if you would look at annual differences in fees, they might be negligible. You would say, oh, why does it matter whether I pay 1 or 1.5 compared to maybe a quarter? On a yearly basis, if you have returns of 7-8%, what does 1% actually mean? In the long run, however, it has significant impact. So just as an example, on the bottom right, if you would invest for, 44 years, so this is a long horizon for an average institutional investor, if you would be paying around 1 to 1.5%, this would be your light bluish or purplish line, $1 invested would then grow towards about $30 over time. If you, however, would go to a fund which is way cheaper, let's say 0.25, which is still very high if you talk about passive investments, because typically that's even cheaper, you would see that your money actually goes after the period to in excess of 50. So you almost doubled your investment return in the long run if you lower your fees. And that is why institutional investors are so keen on lowering fees, and by moving to the core satellite model they can do so. So that's the most important insight that I wanted to share with you on the French article, which of course is in week 3 and not in week 4. So what's coming next week, which is then actually week 4, we're going deeper into the investments. So after having learned about how to balance assets and liabilities, after having learned how the liabilities influence the way you invest, and having learned that there are 2 ways to invest, active and passive, we actually now go into the investments. And we have week 4 and week 5 talking about so-called alternative investments. So these are your typical satellites where you're probably going to be active. And it's something that so far in your academic career probably has not been tackled in a lot of detail. So yes, you've seen equities and bonds, which I would say are traditional. In week 4 and 5, we actually go into the more alternative investments. So on Monday, we talk about private equity, which is of course the counterpart of the listed equities. On Wednesday, we talk about real estate. And the week after, I've arranged a guest lecture on infrastructure, which is even so new that it's not even in the bottom left picture. And then so the week after on Wednesday, we have our second large assignment where we look at the university professors pension fund, which currently has a very traditional asset allocation. And I asked the different teams, can we actually improve that? Can we improve the portfolio by investing in alternative assets? And each team takes a different asset and then acts as a consultant to the university professor's pension fund. Should I invest in this particular alternative asset? I think it's a fun assignment that you're solving. It involves some data collection, so I don't have the data for you on Canvas. You have to go out and find the data, do some calculations. So I would highly advise you to start working early on that. I think, again, it's a fun assignment. Work hard and act as a consultant, because we again ask you to do this in a pitch style, which of course, very much resembles also the process that I go through when I work, in my role, is where I hire consultants to come in and advise me on investing in these assets. So hopefully this helped you a bit. And again, why I'm doing this, I think the main reason is to make sure that you see the overarching picture of the course, that you connect the dots between the different weeks. And also, in every reflection, I try to add some stuff, some examples of how actually in real life all of this theory plays out and why it's relevant and important for institutional investors with a long-term horizon. That's it for now. Thanks a lot for watching, and see you next time. Bye-bye.